Well, thank you. I'm pleased to be here. This is quite an interesting event, and kudos to the Canadian Agricultural Economics Society. This is kind of an event where bring together researchers, but also policymakers, growers, other leaders in the agribusiness sector, others that are interested in agriculture. And just interact, I think, is fantastic. I'm not sure we have anything quite like this in the States. So this is great, and I'm pleased to be here. So I was asked to talk about public-private partnerships. And since I'm from the States and my research interests are largely around the U.S. crop insurance program, I presume that meant to talk a little bit about the U.S. public-private partnership in crop insurance. So what I want to do is talk a little bit about that experience, why the U.S. went down that road, what the experience has been, and then maybe just some summary comments about what I see as sort of the strengths, but also some of the challenges of trying to do crop insurance through a public-private partnership. So for those that are not familiar with the U.S. program, let me just review this fairly quickly. So crop insurance in the States started in the late 1930s. It was one of the New Deal programs during the Great Depression. But up until about 1980, it was actually a very small program, run solely by USDA, federal employees. Then in 1980, the program changed to its current structure as a public-private partnership, where there is a USDA agency called the Risk Management Agency that works with a number of private insurance companies to deliver this program. One thing that I'll point out, and we'll come back to this a little bit later, when this change to a public-private partnership occurred, federal spending on crop insurance was extremely small relative to what the federal government was spending in a host of other transfer programs to the agricultural sector. That reality has changed quite a bit over time. So let me talk quickly about who does what in this public-private partnership. The private sector insurance companies are known as approved insurance providers, or AIPs. These private companies conduct all the sales and also all the claims adjustment on federal crop insurance policies. So there are no federal employees that go out to farms and try to sell policies or anything of that nature. This is all done through the private sector. One of the restrictions here, though, is that these approved insurance providers are required to sell to any qualified applicant who walks in the door and wants to buy a policy. Okay. The gains and losses on these policies, then, are shared with the federal government through a reinsurance agreement, and we'll talk more about reinsurance in just a minute. You probably can't read these are small, but this is a list of about, there are currently, I think, 17 approved insurance providers in this program in the United States. And I think Joe's already left. Joe would probably know this better than me, but my guess would be probably the largest 6 of these would have the vast majority of the business in the United States. All right, well, what does the government do in this partnership? Well, the federal government subsidizes the premiums. They also reimburse these approved insurance providers for their administrative and operating costs, and that's done as a percentage of the premium. They get a certain percentage of their premium that they sell as a reimbursement for administrative and operating costs. The federal government also either develops the policy language, or in recent years, the private companies have been allowed to propose new policies, in which case that policy language has to be approved by the federal government. The federal government also establishes all the premium rates. These private sector companies have no role in premium rating. And then, as we've talked about earlier, the federal government provides some reinsurance. So think about these private sector insurance companies. They're out there selling a policy and taking risk on a policy over which they have no control of the policy language, and they don't get to set the premium rates. Now, because of this reinsurance agreement is a rather strange animal in the sense that it allows these private companies to, the economics term is, to adversely select on the government. So basically what they can do is say, well, okay, this policy, yeah, I think we'll keep the premium on that policy and we'll retain the loss risk. This policy I'm not so sure about. We'll put that one over on the government. The government can take the premium on that, and then they'll have to pay the losses. Okay? Now, there are some bounds on that, but in general, it allows them to allocate those policies as they like. All right, so why this public-private partnership? Why was this decision made in 1980 to shift from a strictly federal program to a public-private partnership? Well, if you go back and read some of the political rhetoric at the time, what you'll hear is a lot of discussion about ad hoc disaster assistance. So it seemed like most every year the federal government was doing some sort of a disaster assistance program on an ad hoc basis for some region of the country that had experienced some sort of disaster. Okay? And if you were a farmer, you wanted to make doggone sure you tried to time your disasters in election years, because those were the disaster assistance was much more generous in an election year. Okay? And so I think people had begun to realize a bit of the absurdity of this situation and the fact that growers couldn't really plan on the disaster assistance. It took a political action for this to happen, an act of Congress. And so you would hear policymakers say things like, well, if we could ever get X percentage of farmers buying crop insurance, then maybe that would take away the political pressure for us to have to try and do these disaster programs. Okay? Now, I'm not sure anybody ever really agreed on what X percent was, but that was part of the discussion at the time. Okay? And so the idea was, well, one way we can try and accomplish this is through this public-private partnership. We'll continue to have federal subsidization of these policies, federal control, but we can manage this without a large increase in federal employees if we leverage the private sector delivery system, insurance delivery system. And so that was the idea. And at the time, in 1980, the federal reinsurance was deemed necessary because there was this belief that, at least at that time, the international reinsurance sector might not have the capacity to handle a major, say, drought across the United States. Now, I think that is another reality that has likely changed pretty dramatically over the last couple of decades. Well, let's reflect back on 35 years of experience with this public-private partnership. What has happened? What's been the impact of this? Well, we now certainly have extremely high participation in crop insurance for major crops in the U.S. So this is for 2015 for corn, cotton, soybeans, and wheat. These four crops, by the way, account for more than about 70% of the insured acreage in this program. And all of them have coverage levels up over 80% of the planted acres. For those that are familiar with the U.S. program, let me point out that this reflects policies where growers actually paid some premium. So this isn't just the free catastrophic coverage. This is growers actually paying some money out of their pocket for insurance. We've really had no significant ad hoc disaster assistance in the United States for farmers since the early 2000s. And even in the early 2000s, it was triggered by low price events, not by adverse weather. And so we've had this tremendous increase in crop insurance uptake, and it has occurred with little, if any, increase in federal government personnel participating in the program. So if we go back to what policymakers were saying in 1980, then I think one would have to say that their goals have been achieved. They did get the very high levels of participation. They did somehow reach levels of participation that they thought were sufficient to forestall disaster assistance. This graph, by the way, shows for the four crops I just mentioned, corn, cotton, soybeans, wheat, but also in addition grain, sorghum, and rice. It shows the acres insured. If you go back to when the public-private partnership started, you're looking at about 40 million acres. For the last several years, we've been up over 220 million acres insured in this program. So again, the growth, yes, has occurred. Okay, so success, well, yeah, but it's come at tremendous cost to the federal government, and primarily in the form of premium subsidies. To put it bluntly, the federal government has bought these levels of participation with extremely high premium subsidies. Again, this graph is showing federal premium subsidies on crop insurance in the U.S. Go back to start in 1991 here, you're at about $200 million a year. If you go back to when the public-private partnership started in 1980, it would have been even lower. Last year, we were at $6 billion just in premium subsidies. You back up a few years to the high price period, and you'll see we've got premium subsidies up over $7 billion per year. By the way, the reason for that is the premium subsidy is a percentage of the premium. The premium is a percentage of the value of the crop. So if the crop is worth more, the premium's higher. That means the premium subsidy is higher. So this is kind of a strange government program when you think about it, right? I mean, we tend to think about government programs that would pay more when prices are low. This is a government program that actually costs more when prices are high, which is just sort of a characteristic of the way that the premium subsidies are done. The other thing I would point out, this is just the premium subsidies. The A&O reimbursements to the insurance companies is roughly about another $2 billion per year. So you're talking about a program that's costing, $8 to $9 billion per year. Okay. Now, I don't recall when we were doing disaster payments that we were making payments anywhere near $8 to $9 billion per year. You could do a lot of disaster payments with $8 to $9 billion a year. So, yeah, was it successful in accomplishing what policymakers said they wanted to accomplish? Yes, but at extremely high cost. Okay. The other thing that's happened over the last 35 years is the program has evolved from being exclusively a yield insurance program to where now, probably 90% of the policies are revenue insurance. Many new crops are now covered, and actually some livestock commodities have started to be covered under the program as well. This is a graph I like, and I'll slow down here just a little bit so you can look at this. The left-hand axis here is the subsidy percentage. So it's the percentage of the total subsidy that the federal government is paying. The right-hand axis is the acres insured. Okay. So you can see if we go back to when the public-private partnership started, the federal subsidy was about 10% of the total premium. For the last few years, it's been over 60%. Now, the subsidy actually varies depending on which product you buy, the coverage level that you choose. So this is an average over across the whole pool of business. Now, I haven't done a correlation coefficient on these two, but man, they sure seem to be tracking pretty close to me. And it seems to me the story there is pretty clear, that it is the premium subsidies that have bought the participation into the program. So. All right, so if we sort of step back a minute from the U.S. experience, it seems to me that and I've talked to people in Europe and other places that are considering crop insurance programs, and one of the things that I always talk to them about is, okay, if you're going to do a public-private partnership, you need to think a little bit about, okay, what is it that the private sector does well, and what is it that the government does well? And clearly, I think one of the real advantages of private sector is delivery. They either have a system in place or can put a system in place very quickly and train people to do sales and claims adjustment. But the question then becomes, is this a social program? And if it is the private sector going to serve everyone? So one of the challenges in the U.S. was, the idea was, well, this wasn't just insurance. This also had some social objectives they wanted to try and accomplish, and so they wanted a program that would serve everyone. And there was concern that these private insurance companies would naturally have incentives to go try to serve the largest growers, maybe the lowest risk growers, and certainly would tend to, makes perfect sense, to congregate or focus your activities in the largest growing regions, and probably be less willing to serve more marginal areas where fewer growers. And so this was the incentive to put in place this idea that they had to sell to whoever walked in the door. But it remains a problem in the U.S. that if you want to buy crop insurance in Illinois or Iowa, there's any number of people that'll knock on your door and try to sell you insurance. If you want to buy insurance in Vermont, you're going to have a lot more trouble finding someone. You may have to drive 100 miles to even find someone who can sell you a policy. Okay. All right, well, what is it the government does? Well, clearly, if you want to have subsidies, it's going to have to be the government that's going to do those subsidies. And I think a real interesting question is this question of reinsurance. And I would argue that global reinsurance capacity has certainly increased tremendously in recent decades. But a question that often comes up is, well, yeah, but reinsurance is really about providing contingent capital to cover those extreme but rare loss events. And nobody can access capital markets cheaper than governments. So why pay private reinsurance premiums in a public-private partnership? Just use the government borrowing mechanism. That's the cheapest way to cover yourself against these extreme events. And when I've discussed this with people in some other countries, the response has been, well, yeah, but our government agency doesn't have access to the national government borrowing authority. We actually have to operate within an annual budget. And so if that's the case, then yeah, you are in a position where you have to use the private reinsurance sector. But even, I would say, even if you do have the government involved some way in providing reinsurance, incentive compatibility becomes really important here. And it would be true whether it's private reinsurance or government reinsurance. If the private sector is the one out there doing the claims adjustment, then you want to make sure they have some skin in the game. That if there's going to be a payment made, that they're going to make part of that payment. Otherwise, what do they care, right? I mean, I'll be incredibly generous, right? It's just government money anyway. So this becomes an issue with these public-private partnerships, is making sure that you try to put some system in place that maintains the right incentives. All right, a few more comments based on U.S. experience, and I'll let you decide to what extent any of this is relevant to Canada. But yeah, as with any government program, crop insurance has created vested interest. And those vested interests use the political process to try and extract rents. I mean, that's the way politics works. And so in the U.S., we have particularly both farm organizations, but now also these insurance companies who are actively utilizing political means to try and either pursue or defend their interest. And these interests don't always align. What's in the farmer's interest may not be what the insurance companies want. And so the government agency that's administering this program is oftentimes caught between these competing interests as they try to make decisions about administering this program. And I say here, increasingly, they're caught also between a number of other interests. And let me explain that point. So since 2014, since the new Farm Bill was done in the United States, crop insurance, I would argue, has essentially become the federal farm program in the United States. If you look at where federal dollars are being spent on agriculture, the lion's share of the money is going into crop insurance, as opposed to any other type of farm program. Okay? And one of my colleagues told a group of insurance companies at a meeting a couple of years ago, as the Farm Bill was being debated, his comment was, be careful what you wish for. The problem with being the federal farm program is you are the federal farm program. And I think we're just now starting to see some of the ramifications of this in terms of how it's affecting crop insurance in the United States, because as with any government program, different interests have different objectives in terms of what they want to accomplish through that program. And certainly in the agricultural sector, I'm sure it's much the same in Canada, different interests want different things from government ag programs. So some are particularly concerned about food safety or domestic food production. Others are concerned about export markets or soil health or water quality or whatever, scenic amenities, whatever. Everybody has something they want out of this. And what we're starting to see in the United States is all these interests have begun to recognize that you follow the money, right? The money is all in crop insurance. And to the extent you want to try and get your concern reflected in incentives to growers, I got to somehow get this done and through crop insurance. But the problem is this crop insurance program is not just a government program, it's a public-private partnership. So as you start trying to accommodate these different interests, you now have private money that's at risk as well. I've been spending a lot of time over the last year or so working with a number of environmental groups in the U.S. who have said, okay, we realize now that crop insurance is essentially the farm program. This crop insurance program needs to create more incentives for cover crops, minimum tillage, whatever your favorite environmental objective is here. So we need to just go make them do this. The response is, but it's not just government money that's going to be affected here. This is private sector. And furthermore, there is no government employee who's out there interacting with farmers on a day-to-day basis. The sales and the servicing, the claims adjustment on all these insurance policies is done by an insurance company employee who has no interest whatsoever in being your environmental regulator out there on that farm. I'm not sure anybody thought through a lot of this stuff when we made crop insurance the farm program. But it's starting to have some serious implications. All right, summarize and I'm done. So public-private partnerships. I think if one is concerned about trying to scale up quickly, at least in the U.S., moving from a strictly government program to a public-private partnership allowed for quick scale-up. Questions that have to be answered, what role for the private sector and concerns about incentive compatibility, what role for the government beyond the obvious one of premium subsidies if it's going to be a subsidized program. Based on the experience in the U.S., one must be aware that the insurance companies are, like anybody else, is going to engage politically to pursue their interest. And the point I just made, that if private money is at risk, it becomes much more difficult to pursue various social objectives through an insurance program. So with that, I will stop, and I look forward to the discussion. Thanks.